All right, so we continue. We having just finished up paragraph 12a, we continue with paragraph 14. Paragraph 14 deals with CGT and disposals by spouses married in community of property. Now remember, when you married, there's two ways of doing it. In community of property, everything's shared 50-50. You each own half of the assets. Or you can be married out of community of property, either in terms of an antenuptial or prenuptial contract. In that case, generally you share 50% of the estate, but not of each asset. So the splitting of the assets only happens if you were to get divorced or die. Now, if you're married in community of property, anything in the joint estate, you share 50-50, which means any time there's a disposal of an asset from the joint estate, spouse 1 has 50% of the CGT in theirs, spouse 2 has 50% of the CGT in theirs. That could be a good thing because each of you will get the annual exclusion. Okay, so this is the one time where being married in community property might actually be a good thing. Then we get to paragraph 15, but linked to paragraph 15, I'm first going to jump randomly to paragraph 53, but it's not random, you'll see why now. Paragraph 53 speaks about personal use assets. Now you might remember from the tax CGT that you've done previously, personal use assets are assets on which you can disregard the entire capital gain or loss on these assets. A personal use asset is defined as any asset used by a natural person, used mainly for non-trade purposes. So if you have an asset that you are not using for trade, and you're a natural person, you disregard any gain or loss on those assets. So think of anything you own that you don't use for your trade. Most of us probably wouldn't even have a trade, so it would be any assets that we own. However, there are certain types of exclusions. These things cannot be personal use. No gold and platinum, okay, I didn't put it there, but it's implied, no gold or platinum coins, no immovable property, so no land, no houses, no buildings, no aircrafts that weigh more than 450 kilograms, no boats that are longer than 10 meters, and no financial instruments. These things can't be personal use, even if they meet the above requirements. Okay, so personal use assets, you're thinking of things like your cell phone, your laptop, your TV, your car. Those type of things will be personal use, and you will ignore the gain or the loss. Now you may think, oh, this is great. But for most of us, think of these assets. They're assets that are going to actually lose value. So if you were to sell them, you'd probably make a loss anyway. So SARS isn't actually being kind here. SARS is saying you just can't use those losses on your TV to set off against, maybe a gain you make on your house. So just remember, anything owned by a natural person not used for trade, excluding gold and platinum coins, immovable property, heavy aircrafts, long boats, or financial instruments. Remember the 450 and the 10? I'm going to often try and confuse you by giving you the length of the aircraft or the weight of the boat. It's aircraft weight more than 450 and boat more than 10. As a bit of real life information, most aircrafts weigh more than 450. Okay, unless it is a very, very small glider or a very tiny, tiny, tiny airplane, but I don't really know any that meet that requirement. Why I did para 53 now is that this is linked to para 15. What it says is that it's a limitation of losses section, and it says if there is a personal use asset, okay, remember the following. We are here. We say what is a personal use asset, what is not. If it is personal use, we ignore the gain and the loss, regardless of what it is. What this one tells you now and says, even if your aircraft is more than 450 and your boat is more than 10, so it's not a personal use asset because it is a heavy aircraft or a long boat. So because it's not a personal use, you're not going to automatically ignore any gains or losses. You'd have to record them. Now what it says is in para 15, any person, so not just a natural person, this can be a company as well, any assets that are not used in trade, if it is an aircraft or a boat, which is heavy or long, you have to ignore any capital loss on those assets. You still have the gain, You still have to recognize the gain, but if there's a loss, you can't recognize it. Okay. Now you may be thinking, well, when would situations like this arise? Well, if you're a rich person and you own a yacht, it's going to be more than 10 meters probably. SARS doesn't want you claiming as a tax deduction, as a capital loss, the loss in value of your yacht. We don't want to reward rich people for buying expensive yachts, using them, and then selling them. It doesn't really make sense. So that's what this is aimed at. People who are not using it in trade, buying expensive things, letting its value decrease, because that's what happens, and then selling it and claiming that as a tax loss. Not really going to work. The key thing here to remember, though, this speaks about assets not used in trade. So if you are an airline, this will not apply if you use an aircraft. If you are a charter company for a boat, this will not apply. This is situations whereby a person or a company own it for pleasure purposes. Okay, so just for fun, for flying, recreation, something like that. You may also be asking, when would a company own a boat if they are not actually using it in their operations? A bit of an interesting story. I'll tell you this from when I was an auditor. I was auditing a major retailer. I probably shouldn't say the name. Well, that's not a bad thing, but anyway. I was auditing them and I was doing their fixed asset register, and I looked on it and I thought, there's a boat on here, like a houseboat. Why would there ever be a houseboat on a retailer's? They sold clothes, on their asset register. This was in Zimbabwe. And what I actually found out was they needed a way to store value as the currency was tanking. So what they did was, and a lot of companies did this, bought boats, bought cars, bought things like that somewhat retain their value, so that as the value of the currency depreciated, they had assets which they could then sell later on to actually recoup a bit of their cash. So I asked for the fixed asset register and I needed proof of the boats. I had to see pictures and things like that. But I just thought it was very interesting. So in that scenario, they would own a boat. It's not for trade, okay? And therefore, if they had a capital loss, they would have to ignore it if it was more than 10 meters. Cool. That's obviously South African tax being applied to Zim, but you know what I mean. Great. So that's paragraph 15 and 53. Just a few basic examples. Please do these on your own. They're very simple. You shouldn't need any of my help there. There's some random paragraphs from 16 to 19. They are things that you need to know. 16 speaks about intangible assets acquired before 2001. No, it exists. Chances of it coming up extremely low, but you do need to know it. 17 is forfeited deposits and the CGT on those. Again, highlight it if you see those words, know where to look and have read it. But again, very, very rare. 18 speaks about the disposal of options. So if you have an option contract, what you need to do is look at the underlying assets and not the option contract itself. So you don't work out CGT on the option, you do it entirely on the underlying purchase. And 19 speaks about losses on the disposal of certain shares, something known as dividend stripping. We'll cover it in GDA, but the basic idea of this is when you buy shares, declare all the value of that company, because you buy enough to have control over the company. Declare all the value of that company to yourself as a dividend. Remember, those dividends are then exempt, so you won't be paying normal tax on them. You'll pay your dividends tax on them, so 20%. And then now obviously the value of those shares has decreased greatly because there's nothing left in the company. You then sell those shares, make a big loss, and claim that as a capital loss. SARS isn't going to allow that, so there's limitations on those losses, but the good news, we'll cover that in GDA. That brings us on to paras 20 to 34. Now, to recap some of the key concepts here, what we are looking at here is the idea of base cost. Base cost, very simply, is what you pay for the asset. I'm going to start here in para 21 and then I'll come back to that. Para 21 says that the following expenditure may form part of the base cost. And here are some examples. Any actual expenses in acquiring or creating the asset. Well, what you pay for it to buy it or to make it. Any valuation costs in B. So anything you pay to have this asset valued for CGT purposes. C, any costs relating to the acquisition or disposal of the asset. So transfer duty, installation costs, advertising costs if you're going to sell it, commission paid to an estate agent if you're selling it, something like that. Remember, important, this is added to the base cost. It's not taken away from the selling price, which a lot of people seem to think to do. D, establishing or defending legal title. What this means, if somebody says this asset is mine and you go, no, it's not, it's mine, and you have a court case, you can include those costs of the court case in the base cost because it's a cost of keeping that asset. A good example here would be the issue of land ownership. If somebody comes and says, you've got my land, and you go, no, I don't, and you go to court and you pay costs and you win, it is your land, you can include those costs into the base cost. Also, very key, any improvements or enhancements to the value of the asset count as going into the base cost. And you'll see here when I go to the next slide, this is quite important because it says the following are not included. And a big one here is B, repairs and maintenance. Now compare the repairs and maintenance to improvements or enhancements. What is the difference? Well, one is going to count for 11D, one is not. So repairs and maintenance will be allowed if it meets 11D as a deduction. So because it's allowed as a deduction, you don't add it to base cost. But improvements or enhancements will not count for 11D, so they won't be deductible. Therefore, you can add them to base cost. Remember, something is either going to be capital or revenue. It can't be both. Other disallowed expenditure, borrowing costs, not allowed. Okay, so that includes 24J. 24J is your interest section. Borrowing costs not allowed. Same reason as repairs. Reason being is that they will be deductible under section 11A. Therefore, you can't add them to your base cost and deduct them. It wouldn't make sense. Okay, so we now know what can go in, what can't go in. And we've also seen from before that you have to reduce your base cost by certain things. So if anything was actually allowed to go into base cost, but you could claim it as a deduction. So let's say there's some way that it counts for base cost and it counts as a deduction. If you are allowed to deduct it, can't be part of base cost. If you were able to claim any VAT, so you incurred VAT, but you're able to claim it back, it reduces the base cost. Any amount reduced or recovered by another person. So if you don't have to actually pay the full amount or somebody else pays it on your behalf, it reduces base cost. A good example here is going to be that debt reduction from 12A. If the amount is reduced, it's going to reduce your base cost. Key, an expense can only be done once. It's either going in your taxable income as a deduction or it's added to base cost. It can't do both. Okay. Now, remember with CGT, CGT only started in the 1st or on the 1st of October 2001. So if an asset was bought after 2001, that's quite simple, just straightforward, whatever meets the requirements. If you had it before 2001, what you have to do is work out the value of this asset on the 1st of October 2001 and then add any qualifying expenditure afterwards. So we're going to need to in some way work out what its value was on the 1st of October 2001. And that's referred to as your valuation date value. So it's the value in 2001 and then your base cost is that value plus anything after 2001. The onus is always on you to prove this. So if you don't keep slips or proof of expenditure, it becomes zero. You have to prove it to SARS. And that's the basics for how you do base cost. The good news, para 20A you can ignore. All right, and then we're going to get onto the specifics and some other random sections next. But for now, keep these basics in mind whenever you are looking at the base cost of an asset.